Okay, so hello everyone. I am KimJ Flores Velila, but you can call me Kim, and our presentation for today is about capital budgeting. So, capital budgeting is also known as a long term investment, and business owners make decisions about the long term investment of a company's capital into operations. They also planning the eventual returns of every piece of equipment that they will be going to buy. For example, machinery and even real estate, if they will earn some profit or a large profit or not. And capital budgeting is also a process that helps in planning the investment projects of an organization in the long run. So on the other hand, capital budgeting is the method of determining the potential of a long-term investment involving a large amount of capital. So let me give you an example of it. So for example, let us now consider capital budgeting for buying a new printing machine by a publishing house. Then the machine is worth 15,000 and let's just say that it will generate a return of 3,000 annually. This payback period of the machine is 5 years and the expected annual rise in inflation is 10%. So now, let's calculate the real investment value after a year. So the real value of profit is 15,000 plus 3,000 divided by 1.1 is equals to 1,636. Then we can say that the actual company's profit after a year is estimated at 1,636 instead of 3,000. And now let's talk about the features of capital budgeting. So what are the features of capital budgeting? So we have here huge funds. So what is huge funds? Huge funds is a capital budgeting involves expenditures of high value which make it a crucial function for the management. So of course, when you are planning or trying to put up yourself in a business, kailangan mo na malaking capital or funds sa business mo. Why? Kasi syempre kailangan mo gumastos for the expenses of buildings, land, and even sa mga equipment na gagamitin ng isang business. Second is high degree of risk. To take a decision that involve huge financial, the burden can be risky for the company. So dito naman, we all know that in a business, you have to take some risk. So if ever na magtatayo ka ng business, kailangan buo talaga or tama at determinado ka sa desisyon na gagawin mo. Kasi malaking halaga yung ilalabas or gagamitin mo dito. It's just like gambling. You have to take a risk if you're going to beat all of your capital or not. Third is affects future competitive strength. So the company's future is based on such capital expenditures decisions. Sensible investing can improve its competitiveness, whereas a wrong investment may lead to business failure. So in this feature naman, dito din papasok yung tinatawag natin na decision making. Kailangan magaling kang magdesisyon sa ganitong bagay, especially kung saan mo gagamitin yung capital or fund mo. Dapat nakaplano ang lahat. Kasi kung walang plano or mali yung plano mo, maaaring maligi yung business mo. Pero kung maganda yung pagkakaplano mo, then magiging maayos din yung takbo ng negosyo mo. Next is difficult decision. When the future is dependent on capital budgeting decisions, it becomes difficulty for the management to grab the most appropriate investment opportunity. So yes, decision making is also one of the most difficult task to do, not just only in business but also in your personal decision in life. But when it comes to business, mahirap talagang magdesisyon kasi lahat ng desisyon na gagawin mo hindi palaging tama and may times na sa business di mo alam or mahirap magdesisyon kung saan mo ba dapat i-invest yung capital mo kasi baka mamaya mali yung mapaglagyan mo ng investment mo. Next is estimation of large profits. Any investment decision taken by the company is made with the perspective of earning desirable profits in the long term. So yun na nga, sa business, every investment decision na gagawin mo or ng company is nakapokus kung magkano ba yung mai-earn mo na profit at mag-earn ka ba ng malaking profit. Siyempre sa business, di talaga mawawala dito yung usapang kita or pera or profit. Kasi yun talaga yung focus mo simula una ang kumita. But not just only to earn, but also kung gaano ba tatagal yung company and yung kita ng company mo or ng organization. Next naman is long-term effect. So the effect of the decision taken today, whether favorable or unfavorable, will be visible in the future for the long term. So yun na nga daw, every decision na gagawin mo, even if it's favorable or unfavorable, maganda man or masama yung kinalabasan ng decision mo, is makikita at makikita mo pa rin yan, di yan mawawala. Kasi pang matagalan yung effect nun sa business. Not just only sa business, but also to those people inside the company. Next is affects cost future structure. The company's cost structure changes with the capital budgeting. For instance, it may increase the fixed costs such as insurance charges, interest, depreciation, rent, and etc. So yun na nga, kahit na sabihin natin na naka-fix na yung budget mo or capital mo for the business and nakaplano na yon, syempre may tendency pa rin na mabago yung cost ng mga kailangan sa business. Katulad na lang halimbawa sa rent at pati na rin sa mga materials na gagamitin mo. Kasi di mo naman masasabi kung kailan tataas yung price ng isang product or etc. Kaya maaari pa rin mabago yung expenses mo kahit sabihin mo na nakaplano na yun at kasama na yun sa budget. And next is irreversible decision. A decision once taken is tough to be amended since it involves a high-value asset that may not be sold at the same price once purchased. So yun na nga, once na nag-decision ka na and nabili mo na yung isang product, halimbawa, is irreversible na siya or hindi mo na maibabalik kasi nabili mo na eh. Halimbawa, bumili ka na sa sasakyan sa mataas na halaga, tapos nagsawa ka or ayaw mo na sa kanya, then pagdesisyonan mo na ipagbili na lang yon. Pero yung price nun is hindi na katulad nung unang beses na binili mo yon kasi nagdi-depreciate yon at nagluluma. Kaya naiiba yung value ng isang bagay habang tumatagal. And the last one is the importance of capital. So why capital is important? Because it creates accountability and measurability. It helps in planning the investment projects of an organization or business in the long run. So these are the importance of capital budgeting. So first, we have here long-term goals. So bakit siya importante? Importante siya para lumago at umunlad ang isang business. Kailangan may goal, which is yung pangmatagalan talaga. And syempre, dapat maganda at tama yung decision mo kasi once na hindi tama yung naging decision, maaari itong mag-cause na hindi maganda sa business for the long run. Second, involvement of large number of funds. So may mga business na limited lang kasi yung mga resources nila. That's why they have to make a wise and correct investment decision, especially malaking capital or fund yung ilalabas nila. Kaya importante na mapag-aralang mabuti yung decision na gagawin bago magtuloy-tuloy. Next is irreversible decision. Ito, nabanggit ko na ito kanina. So, mahalaga din siya kasi kailangan nga pinag-iisipang mabuti yung decision na gagawin mo kasi mahirap na baguhin. For monitoring and controlling the expenditures. This is important kasi kailangan ma-monitor mo yung mga actual activity na nakaplan para ma-control mo yung mga expenditures para ma-ensure na naka-inline yun sa available fund or sa budget or kasama talaga siya sa budget mo yung produkto or yung activity na gagawin nyo. Number 5 is transfer of information. Kasi the time the project starts, there are numerous decisions na nagawa na. But titingnan pa yun kung acceptable ba or rejected yung mga ideas na binigay nila. And yung mga information naman na yun is ita-transfer sa appropriate decision maker ng isang company or ng organization. 6 is difficulties of investment decisions. Okay, this one is also important in capital budgeting kasi kailangan tama yung forecasting mo sa product halimbawa. And pati na rin yung mga cash flows. Kasi hindi naman ganun kadaling mag-compute or mag-estimate ng gastos and pati na rin ng mga revenues. Kasi baka mamaya overestimate yung revenues or underestimate yung cost. And a project that looks profitable could become a money loser. Last but not the least is maximization of wealth. This is the concept kung saan magi-increase yung value ng business in order to increase the value of shares held by its stockholder as well. So, one of the example of this is yung pagbabago ng price ng shares ng company. So, that's all. Thank you and have a nice day.
Hi, my name is Christine Santa and I will be discussing the types of investment decision. So, we have two types of investment decision. So, the first one is on the basis of expansion and the second one is on the basis of dependency. So, on the basis of expansion, we have expansion of existing business, expansion of new business, and replacement and modernization. So, business expansion is the stage where the business reaches the point for growth and seek out for the additional option to generate more profit. Example of expansion of existing business is adding employees or labor, adding franchises, forming an alliance, or offering new product and services. So the next one is expansion of new business. So the different form of expansion of new business is opening in other location or the business will expand globally. So this is what you call the greenfield investment. This is the type of foreign direct investment where the company starts its operation in other country as its subsidiary and will invest in the construction of office, plant, building, etc. And the third one is replacement and modernization. So the main objective of modernization and replacement is to improve operating efficiency and reduce costs. So replacing a fixed asset due to the expiry of economic life of asset is called replacement decision. Example is replacement of equipment. And replacing a fixed asset due to technological obsolescence is known as modernization decision. Example is purchasing new improved machine to help the business operation. So the second type of investment decision is on the basis of dependency. So we have a mutually exclusive investment. So mutually exclusive investment are a set of prospective capital investment where the selection of one investment automatically excludes the other project from being funded. For example, a company may either use a more labor-intensive or semi-automatic machine. And choosing the semi-automatic machines precludes the acceptance of the highly automatic machines. So in short, only one several potential project can be chosen. So the second one is independent investment. So independent investments serve as a different purpose and do not compare with each other. So in short, it has no impact on our decision to choose another project. So accepting or rejecting one project does not affect decision of other project. For example, there is no effect even if you accept the more labor intensive and when you reject the semi-automatic machine. So the last one is contingent investment. So contingent investment are dependent project. So the choice of one investment undertaking one or more other investment. So example, if the company decided to build a factory in a remote backward area, it may have to invest houses, roads, facilities for employees, and anything that need in production. So the total expenditures treated as one single investment. So again, the two types of investment decision is on the basis of expansion and on the basis of dependency.
My name is Rachel Agpelas and I'll be reporting the stages in investment process. First, generating alternative investment proposals. Alternative investment proposals such as financial asset that does not fall into one of the conventional investment categories. Conventional categories include stock, bonds, and cash. Second, estimating the incremental cash flows associated with projects. Incremental cash flows are estimated by comparing the company's net cash flows if the project is accepted or not. It is important to consider the effect of acceptance of one project on the cash flows of another. A positive incremental cash flow means that the company's cash flow will increase with the acceptance of the project. Third, estimation of required rate of return. Required rate is used as a threshold that separates feasible and unfeasible investment opportunities. The general rule is that if an investment's return is less than the required rate, the investment should be rejected. Fourth, evaluating and selecting project. Why is it important that organizations select the right projects in the first place? First, ensure that the project aligns with your organizational strategy. You need to make certain that the prospective project aligns with your overall organizational strategy. Second, identify project champion. Without a clear assignment of responsibility and advocacy, a project can falter. But with a proper identified champion, a project can falter, but with a properly identified champion, you can make sure everything proceeds as smoothly and efficiently as possible. Third, conduct an organizational and environmental assessment. This is the key for helping you better understand the context in which you will undertake your project. Fourth, assess your resources. You need to evaluate the resources you have at hand to accomplish the project ahead. Resources may mean people, time, and budget. Project for which you can do not have sufficient resources may stall and become an ongoing drain on your organization, while less ambitious projects may help you reach a position from which you can more easily accomplish more expensive or time-consuming goals. Fifth, identify your parameters for success. As you set out on your undertaking, nail down your parameters for completing the project, particularly the time frame. As you consider time frames, you should also decide on the metrics by which you will measure success.
Good day, I'm Jaisan Oraa, and my part to our report is the decision-making criteria in capital budgeting. These are the things that the ideal evaluation method should use. First, include all cash flow that occur during the project. All cash flow means all in and out of the money from the enterprise. Second, consider the time value of money. Time value of money is the worth of money that you have now more than to its future due of the earning potential value. And lastly, incorporate the required rate of return in the project. Required rate of return is the minimum of the investor that is expected to achieve by the said investing project. Capital budgeting criteria. There are 4 phases. First is the net present value. Second is the internal rate of return. Third, profitability index. And lastly, the payback period. The net present value, internal rate of return, and the profitability index is based on the capitalization of all cash flow and discounted cash flow technique. While the payback period doesn't rely on discounted cash flow technique because payback period is the amount of time that is required to pay by the said investment. Thank you.
Hi, I'm Marjoy Leonilio, and my topic is discounted cash flow. I know you guys already have an overview about this topic, but let me tackle this once again. Okay, listen. DCF or discounted cash flow, it is also known as opportunity cost of capital or cost of capital. When you said DCF, it is also known as opportunity cost or discount rate. Opportunity cost, it is something that you would give up in order to get something else. For example, in personal life, you have 2 choices. What would you choose between your love life and your career? If you choose your career, then you lose your love life. If you choose your love life, then you lose your career. The same thing in the company. You have two options. Which one is better? 1. You're gonna invest in a bank with an expected annual return of 8%. Or 2. You're gonna invest in a project proposal in your company with an expected annual return of 10%. And then after that, there's a follow-up question. What is the opportunity cost if I do invest in a bank? The answer is 10%. Why? Because I lose 10% that I could have gotten if I invest in a project proposal. Next is, what is the opportunity cost also if I invest in a project proposal? Of course, the answer is 8%. Again, opportunity cost is something that you would give up or lose. Now, why do people like the opportunity cost? Because people think rationally and they would weigh the pros and cons of each activity before to do or choose the best option or alternative plans at the same time. The main idea of this topic is the time value of money or TVM. As you can see in the picture, the money in your hand is worth more today than the same money tomorrow. Why? Because it depreciates. Money depreciates over time when you're not putting it into use. And money increases when it earns interest. Time value of money is not just about the money, but it is also about the time as well. And this concept brings us to the fundamental of TVM, which is necessary to understand before heading to the next topic. Number 1 is future value. It is used to estimate how much an investment made today will be worth in the future. And here's the formula. Future value equals present value quantity of 1 plus discount rate raised to numbers of years. For example, how much money will I have 1 year from now if I invest 100 pesos with unexpected 20% annual return? And here's the answer. The future value is 120 pesos. Number 2, present value. It is used to measure the current value of an amount of money. And here's the formula. Present value equals future value over quantity of 1 plus discount rate raised to number of years. Example, how much money do I invest to achieve 120 pesos 1 year from now with an expected 20% annual return? The answer is the present value is equals to 100 pesos. Net present value or NPV. The keyword here is the net. Net is the sum of all present value minus the present value of all cash outflow. And here's the criteria for NPV. If NPV is greater than 0, then accept the project. If NPV is less than 0, then reject the project because it is not pursuing. If NPV is equals to 0, then accept the project considering non-tangible asset. Remember, the greater the NPV, the better the prospect. Example on calculating NPV. A sum of 1,000 invested today in an ME project may give a series of below cash inflow in the future. Year 1, 400, year 2, 400, year 3, 400, and year 4, 400 as well. If opportunity cost of capital is 20% per annum, should we accept or reject it? Here's my answer. Since the NFV value is 38 and it is greater than 0, we can accept the project. Remember, the higher the discount rate, the lower the NFV will get, and we need to reject it. Internal rate of return, or IRR. It is the percentage of return on investment. To put it simple, it is the percentage of return of your investment. So how do we calculate IRR? Here's the formula. You know what, guys? NPV and IRR are connected to each other. As the discount rate increases, then the NPV decreases. The NPV changed with the change in discount rate of interest. Therefore, the NPV is very dependent on discount rate. In this case, we need to figure out at what discount rate does the value of NPV become 0. Here's my example of IRR. Let's say at 8% discount rate, the NPV is 5,000. And let's say at 12% discount rate, the NPV becomes 0. Then the 12% is the return that we're getting from the project, and that 12% is called internal rate of return, or IRR. Here's the criteria of IRR. If the internal rate of return is greater than discount rate, then accept the project. If the internal rate of return is less than the discount rate, reject the project. And if the internal rate of return is equals to discount rate, accept the project. Profitability index, in short PI. It is determining for every money we spend how much are we getting back. You know what? It's easy to calculate profitability index. The formula is the sum of all cash inflows over the sum of all cash outflows. PI's criteria is if profitability index is greater than or equal 1, accept the project. If profitability index is less than 1, reject the project. Here's my problem and answer.
We have saw or seen the first method, which is the discounted cash flow. And now, I'm going to report the non-discounted cash flow. Under non-discounted cash flow, so there is three method or techniques. The first one is payback period, discounted payback period, and lastly, accounting rate of return. So what is a payback period? So from it words itself, payback period, so we're talking about to the return or payback of the cash investment we made. So for you to understand more, I will give an example. So here is the example of payback period. For each example, there is initial investment costing for 250 with a cash flow for year 1 100, year 2 100, year 3 100, year 4 100. The question in this payback period, in what period or time we can recover or buy back this amount of 250? So for this problem, in year 1 we have 100 equals 100, year 2 100, add therefore 200, year 3 100, add therefore 300, year 4 100, add therefore 400. So we can see that this cost 250 is between year 2 and year 3. So we can see that in year 2 there is a cash flow of 200. So we can see there is a remaining 50 to fulfill this amount of investment, 250. So we're going to derive our formula, which is this one. Payback period is equals to cash outlay investment, which is the 50, and the over annual cash inflow, which is the 100. So we can see it is in between 2 and 3 years. So we will write 2.50 over 100 is 0.5. So the payback period to recover this 250 investment is 2.5 years. I hope it is a good example. Under non-discounted cash flow, we had discounted payback period. So it's just like the same with the payback period earlier. The difference is there is an discount rate that we're going to use. So for you to understand and for you to compare the difference from payback period and discounted payback period, I will give an example. So here is the example of discounted payback period. So for you to easy to understand, the example in payback period and discounted payback period are same. So and then we can differentiate its difference from payback and discounted payback period. And the first difference is in discounted payback period, there is an discount rate of 10%. Same initial cost of investment, 250. In year 1, there's a 100 cash flow. Year 2, 100. Year 3, 100. Year 4, 100. And the difference is we need to discount this cash flow with this discount rate, 10%. So in year 1, there's a 100 over 10% raised to 1 because it's 1 year is equals to 91. In year 2, 100 over 10% raised to 2 because it's 2 years equals to 83. Then so on and so forth. So now there's a list for discounted cash flow: 91, 83, 75, 68. So 91 equals to 91. Year 2 there's an 83, add. Therefore 174. Year 3 there's an 75, add. Therefore 249. Year 4 68, then add. Therefore there are 317. So we can see that we can recover or pay back this initial investment 250 between year 3 249 and year 4 317. And we can see there's 1 peso to fulfill this 250. So that is the from the formula cash outlay investment. So that's the one. And the annual cash inflow, which is in year 4 68. So we can see it's between year 3 and year 4, so we can easily write the 3. So for this one, 1 over 68, the answer is 0.15. So we can the discounted payback period is 3.015 years. So lastly, under non-discounted cash flow, there's a technique that accounting rate of return or ARR. So accounting rate of return calculates the return generated from net income of the proposed capital investment. So for you to understand more, I will give an example. So here is the formula of ARR or accounting rate of return. So ARR is equals to average annual operating income from asset over initial investment, or ARR is equals to average annual net cash flow minus annual depreciation expense over initial investment. So for each example, there's an equipment costing for 240,000, then a residual value for 30,000, because equipment can be depreciated, so there is an residual value. For annual cash flow, there is for year 1, 100, year 2, 80,000, year 3, 50,000, year 4, 50,000, year 5, 50,000, year 6, 30,000, with a total of 360 annual cash flow. So to get the average annual cash flow, so this total annual cash flow 360 over 6, because it's 1 2 3 4 5 6 here, is equals to 60,000. Therefore average annual cash flows is 60,000. And then we're going to find the annual depreciation expense. So to find it, this equipment 240,000 minus the residual value of 30,000 over 6. So the annual depreciation expense is 35,000. So to get the ARR, so we're going to back to the formula. ARR is equals to average annual net cash flow, which is the 60,000, minus annual depreciation expense, which is 35,000, over the initial investment 240,000, which is the equipment. So 60 minus 35,000 over 240,000 is equals to 10.42%. So the accounting rate of return is 10.42%. Thank you for watching. I hope you learned